Welcome everyone. This is Popijo FS right here. Welcome to another session of Popijo Trading Academy Advanced Course Content. So we'll be looking at liquidity concept for today. And one thing about liquidity concept is that it is a very important and a very popular concept in smart money trading. So if as a trader that you want to trade and you are trying to learn the smart money concept, liquidity is one key part that every trader using the smart money concept wants to understand. You understand? But the way we want to understand it also matters, and the kind of idea we also have about it also matters. Do you understand? Because one thing about the liquidity concept is that the way many people tend to you see it is quite different from the actual fact of what liquidity is. Now, I tend to see liquidity as simply orders in the market. Now, liquidity could just mean it is money in the market. Do you understand? Now, it means money in the market, but obviously, you need to know where those money are, what kind of pattern does this kind of structure form? Like, what structures give you the idea that there's money here or there's money there? So basically, everywhere in the market is liquidity, because everywhere that a buy order or a sell order has taken place, then there's cash. That means there's money being transacted and there's money being exchanged at that point, at that price. So now let's go further and explain the liquidity when it comes to structure based. That's when we talk about the internal liquidity and then external liquidity. Now this is based on structure. That's what we'll be talking about, the internal liquidity and then the structural liquidity. But basically, what I just want to explain is that any order in the market, anywhere there are orders, when you take your order, when you take your buy order or you take your sell orders, you have just what generated liquidity in the market. Meaning, in the market, as well as we know that there are a lot of traders trading all over the world. Meaning, as they're taking their buy orders or taking their sell orders from different prices, then that means what there are different liquidities at different areas in the market. Now, what we tend to do is that we tend to look for where these liquidities are being packed. Meaning, we tend to look out for where there are a lot of liquidities. So, examples of such are stop losses. Meaning, no, your stop loss order too is a your stop loss is an order in the market. So we tend to look out for these areas whereby structurally there are what liquidities. That means there are orders in the market. When we talk about the resistance now, when market gets to resistance, we obviously know that market wants to sell from a resistance, meaning there are a bunch of orders there, but there are a bunch of traders that are waiting for that resistance to come and they want to sell from that resistance, meaning there are what lot of orders there. Now that is where we bet the concept and name liquidity pool, meaning an area in the market where there is a lot of order being packed. At that point, that's where we bet the concept liquidity pool. Now, one thing to note about liquidity also is that apart from being our stops, because that is one very key example of a liquidity in the market, is what the stop losses in the market. So apart from that also, and also the formation and the places where they form, that is where we talk about the structure part of it. So basically, I'll just be explaining some basic concepts and some basic structures in identifying liquidity in the market. So the structures I'll be talking about the relatively equal liquidity structure. That is number one. That means when we have equal highs or equal lows in the market. So in the case whereby we have an equal high like this, what this kind of structure has just shown us that there's liquidity at this high here, meaning the market is moving to come and clear this liquidity now. Now this is a function of the market makers. Anywhere they see liquidity being packed or being stacked in the market, they tend to move price there to go and take those liquidity. Now this is a function of the market makers. Now we just need to know, once we understand this concept of liquidity as well, we just need to think along with them and also trade along with them, because we know some of their trap moves and also some of their moves. So if you know those moves, then the next thing we can do is what we can capitalize on those moves also and also make profit from the market. So it's just like we are trying to follow the footprint of the market makers, but then we need to know how they are actually moving the price, which is why we study liquidity concept in the first place. Because liquidity, which understands that is the order in the market or pile of orders in the market, and this market makers moving price there to come and clear the liquidity there. Then once we are able to identify the structures, then the next thing is that we will be able to trade those kind of structures and those kind of trades. Now, example number one is what when we have a relatively equal structure. Obviously, we understand that when we have an equal high, retail traders automatically classifies it as a resistance, and obviously their stop losses and their buy stop orders are at those levels, which is why markets comes to those places to come and clear it. So that is what we understand by liquidity structure of equal highs. In the other sense also, we could also have a kind of equal low liquidity structure as well, whereby we have markets reversing exactly at equal low here, and then later on market coming to clear that equal low. That means we have this kind of pattern too and this kind of structure in the market. So example number two and the structure number two is the swing structure. We have the swing structure liquidity. So anytime we have any swing high or swing low in the market is generally quite referred as liquidity point or a liquidity structure. Meaning anytime we have a turning point in the market like this turning point, this swing high here that we have exactly around here, that swing high is generally referred to as liquidity. But it now depends on how it forms or where it forms. Now, this high here now, the most important ones that we regard as liquidity are probably we have the previous day high or a previous day low. Now, a previous day high happens or turns out to be a very important liquidity swing structure. So example of this liquidity string structure is when we have an a previous day high. Because in this case also, market makers have trapped volume at this high here. They have trapped volume, meaning they come back here to take the liquidity at that high and then reverse price lower. So we also need to take note of this pattern happening in the market so we can also take and capitalize on it. The another pattern that we have is what we have the trend line structure. Now, for most retail traders that use trend line, and anytime we have a very perfectly fitted trend line, the next thing we should understand is that there's a build up of liquidity at that trend line. So if you have a perfectly fitting trend line like this, if you have a perfectly fitting trend line like this, then you know that there's a liquidity being built up at this point. Meaning market makers will tend to take price lower at that point to take the liquidity of that structure before reversing price higher. So one just needs to understand the way the market makers engineers this liquidity and also take the liquidity, which is why we need to study the structure of liquidity. And I've shown you three examples, both in the bullish scenario and also in the bearish scenario, which is this relatively equal liquidity structure, the trend line liquidity structure, the swing point liquidity structure. So this is happening in the bullish scenario and also in a bearish scenario. Remember, we talked about the liquidity pool. Liquidity pool is just basically where there are stacked of orders. That means it depends on how long or how strong or the time frame these structures actually form. That means if this structure is forming on a higher time frame, then probably we know that those points are very they are points whereby there will be some volume of orders being stacked at those points because they are formed from a higher time frame perspective. So that is that. Now we'll be going and we'll be seeing some other series of liquidity concepts. Liquidity concept actually happens to the next series. We'll be talking about the structure type, which is internal liquidity and then the external liquidity. Then subsequently, we'll be talking about the liquidity of the trend line phantom. We'll be talking about the head and shoulders, and then we'll be finally talking about the liquidity inducement theory. Thank you.